Welcome to MultiPrime Briefings. I'm Matthew, and joining me as always is Ruth. Ruth, good to be back.
Good to be back. Lots to get into this week.
Let's start right at the top, because the lead story this week is one of those numbers that just sits with you. STT-GDC surveyed major organizations in Thailand on AI adoption, and the headline finding is this: 78% have moved past experimentation. They're not just dabbling, they've progressed. And yet, not 1-0 has achieved enterprise-wide AI leadership status. Not one organization in the survey crossed that finish line.
Zero.
And I think the instinct is to read that as a technology story. We don't have the models, we don't have the infrastructure. But when you look at what leaders actually cited as the barrier, it's budget constraints and inability to measure clear ROI. That's not a technology problem. That's a governance and measurement failure.
Okay, but I want to push on that framing a little, because you could argue, and I think some leaders would, that the measurement problem is the technology problem. The reason you can't measure ROI is that the tools aren't mature enough to produce clean attribution. You can't cleanly separate what the AI did versus what a better trained human would have done. So the CFO says, "Show me the number," and the CTO says the number doesn't exist yet, and everyone's stuck.
That's a fair challenge, and I'll grant you that attribution is genuinely hard in some cases. But here's where I'd push back. The organizations that are winning globally are not waiting for perfect attribution. They're defining proxy metrics upfront: time to decision, error rates, throughput per analyst, and they're governing against those proxies. The measurement framework is a choice you make before deployment, not a discovery you make after. The Thai organizations in this survey appear to have deployed first and asked, how do we measure this, second?
That's the retrospective ROI trap. Everyone falls into it.
Exactly. And the consequence is this: you've got 78% of organizations sitting in a kind of purgatory. They've invested enough to move past pilots, they've generated some internal proof points, but they cannot make the case to the board or the CFO for the next serious tranche of capital. So the AI program plateaus. And here's the compounding risk: infrastructure costs are rising. Thailand just repriced data center electricity. We'll get to that in a moment. The longer you sit in purgatory, the more expensive it gets to eventually scale.
Right. So the 78% aren't just standing still. They're standing still while the cost of moving goes up.
Which is a form of moving backward. And I'll say something slightly contrarian here. I think part of the reason this is so prevalent in Thailand specifically is that there's been a cultural pattern of adopting technology for its signaling value, having the AI program, being seen to innovate, rather than for its operational outcome. The pilot itself was the deliverable. When you treat the pilot as the deliverable, you never build the scaffolding for scale.
Okay, that's a bit brutal. But honestly, not wrong. I've sat in enough AI showcase presentations where the demo is immaculate and the production deployment is a Word document somewhere.
And nobody's going back to ask what happened to that Word document. So who wins and who loses from this gap? I think the winners are the organizations, and there will be some, they're just not in this survey, who have invested in the measurement infrastructure first. Who've appointed someone to own the ROI framework, not just the model deployment. Those organizations will consolidate competitive advantage very quickly, because the gap between them and the 78% stuck in purgatory is only going to widen. The losers are those who keep adding pilots to the portfolio thinking that quantity eventually becomes quality.
And what do you watch next? How do you know if an organization is actually making the turn?
3 signals. First, do they have a named owner, not of the AI project, but of the AI ROI measurement framework? Second, are they retiring pilots? Are there AI experiments that they've explicitly killed because the metrics didn't hold? A portfolio that only grows is a portfolio that's never being evaluated. Third, are the business unit leaders, not just the CTO, able to articulate what the AI program is doing for their P&L? If it's still a technology story told by technology people, you haven't crossed the threshold.
Those are actually good diagnostics. I'd add a fourth. Is the measurement framework in the board pack? Or is it still in a slide deck that the CDO presents once a quarter to the strategy committee and nobody reads?
Fair addition. Board-level visibility is a forcing function for rigor in a way that internal dashboards never quite are.
All right, let's move to macro. US CPI, 3.4% annual for July.
Second consecutive month of easing, driven mainly by falling energy prices, which met expectations, so no real surprise factor. Markets had priced this in. The headline read is that the Fed now has more room to maneuver on rate cuts.
But more room is not imminent cut.
Exactly the right distinction to make. Core services inflation is still sticky. One soft print driven by energy, which is notoriously volatile, does not establish a disinflationary trend. I would not be repositioning a balance sheet around the assumption of near-term Fed cuts based on this number alone.
For Thai executives specifically, the more interesting question is probably the dollar. If the Fed does move toward easing, the USD typically softens, which gives the THB some breathing room. That matters quite a bit for companies with USD debt or for importers.
It does, but I'd urge caution about treating a potential Fed pivot as a reliable THB tailwind. The relationship between Fed policy and emerging market FX is not linear. It gets interrupted by geopolitical shocks, by risk-off moves, by commodity swings. The right posture is to watch the trend over 2 or 3 more CPI prints, and in the meantime maintain your hedges rather than unwinding them on the basis of one data point.
Boring but correct advice.
I have never been embarrassed by boring and correct.
Right, industry. Let's do data centers first because it connects directly to the lead.
Yes, so the scale of the AI-driven investment boom in Thailand's digital sector is genuinely remarkable. BOI applications for digital projects exceeded THB 873.7 billion in the first quarter of 2026 alone. That's not the full year, that's one quarter. The demand is real. The infrastructure pipeline is real.
And then the regulators showed up.
Thailand's Energy Regulatory Commission is building a new screening framework covering electricity consumption, water management, and grid stability for data centers. Separately, the National Energy Policy Council has approved a higher, dedicated electricity tariff for data centers, specifically to reflect actual supply costs and to protect household consumers from bearing the subsidy burden.
Which, honestly, is fair. If you're running a hyperscale data center drawing the equivalent of a mid-sized town's power supply, you should not be paying the same tariff as a family in Chiang Rai.
Completely agree. This is rational policy. But rational policy still changes investment economics, and the timing matters. Developers who secured BOI incentives before these changes are largely insulated. New entrants coming in now are facing a materially different cost structure and a longer, more uncertain approval process. That's going to slow the tail end of this pipeline.
Does it redirect investment to other ASEAN markets? Vietnam, Malaysia?
Possibly at the margin, yes. Malaysia has been aggressive on data center approvals, though they've had their own grid concerns. Vietnam is building capacity, but the regulatory environment is less predictable. Thailand's advantage is rule of law clarity and connectivity infrastructure. The new screening framework actually reinforces that advantage long-term by preventing the grid from becoming a liability. But short-term, yes, some prospective investors will recalculate.
Airlines next. McKinsey's piece on premium leisure travel. I'll be honest, I found this one slightly obvious. Rich people are flying business class on holiday is not a blinding insight.
Fair. The observation itself is not new. But the strategic implication for carriers and hubs is underappreciated. The entire premium cabin product development, loyalty program design, and marketing investment of most airlines has historically been calibrated around the corporate traveler, the consultant flying weekly on a managed travel program, the executive with a company card.
And that client has partly disappeared, or downgraded.
Right. Zoom ate some of it, cost pressure ate some of it, but the affluent leisure traveler has filled the cabin, and they have completely different needs. They're not loyal to your airline because their employer mandated it. They're choosing you on product, on experience, on how you position the cabin for a honeymoon or a family trip to Japan. The carriers who haven't recalibrated their premium product strategy around this new buyer persona are going to find their yield deteriorating even in a full cabin.
Thai Airways is an obvious reference point here. Long-haul premium product, going through restructuring, the question of who they're actually designing the product for is not a trivial one.
Exactly. And for Bangkok as a hub, this is actually an opportunity. Thailand is a premier leisure destination, which means there's a natural alignment between the traveler who wants premium leisure and the traveler who might be landing here. Carriers and the tourism authority should be thinking about this together, not separately.
Healthcare CFOs. Deloitte survey. 74% heavily involved in consumer affordability and patient experience strategy. Only 41% feel equipped.
That is a genuinely alarming readiness gap. And the context is important. Healthcare CFOs are being asked to lead not just on financial controls but on care model transformation decisions, on M&A due diligence in an industry that's consolidating fast. These are strategic calls, not accounting calls.
In Thailand's private hospital sector, this is very live. You have several large hospital groups that have been acquisitive, regional expansion, buying up networks. The CFO is being asked to underwrite the strategic logic of those deals, and if 59% don't feel equipped to do that, that's a governance risk that sits directly in the boardroom.
The fix is not just training, it's structural. You either beef up the strategic capability inside the CFO's team, or you separate the strategic function more cleanly from the finance function and make sure they're working together rather than the CFO being expected to be both things at once.
Capability Corner. Bain on AI pricing.
This one I found genuinely useful. Bain is looking at how B2B software companies are trying to evolve their pricing as they embed generative AI, shifting from seat licenses toward usage-based or outcome-based models. And the core tension they identify is that outcome-based pricing requires clean attribution, and clean attribution is very hard to achieve in practice.
Which connects directly back to our lead story.
Completely. The AI ROI measurement problem that's trapping Thai organizations in scaling purgatory is structurally identical to the problem that vendors face when they try to price on outcomes. If the buyer and seller can't agree on what the outcome is worth, the contract either defaults to a proxy, seats, API calls, or it becomes a negotiation in bad faith where both sides are making up numbers.
And the risk for vendors who rush to outcome pricing before they can actually measure outcomes is that they destroy their own margins. You sign a contract promising to deliver X% efficiency gain, you can't actually measure whether you delivered it, and then when renewal comes up, the client says prove it, and you can't.
Exactly. Bain's practical advice, which I think is right, is that the transition to outcome-based pricing needs to be sequenced carefully. Measure first, price later. But here's where I'd push back on their framing. They present this as primarily a vendor challenge. The buyer's challenge is equally important. If you're a Thai procurement team evaluating an AI contract, and the vendor is still on seat licenses while the market is moving toward outcomes, you should be demanding a measurement framework as a contract term, not as a nice-to-have addendum, but as a condition of renewal. Lock in the measurement methodology before you lock in the spend.
That's the version of this advice that actually protects the buyer. Bain's piece is written for the software company, not the enterprise customer.
Which is fine. Know your audience. But readers of this briefing are largely on the buying side, so the translation matters.
From the firms. 2 McKinsey pieces worth flagging.
First, AI transformations run on trust. The thesis is that technology powers AI transformation, but people determine whether it succeeds, transparency, clarity, investment in employees. It's a good argument, and I don't disagree with it.
But
it's too comfortable. McKinsey frames trust as something you build through communication, town halls, change management, being clear about the roadmap. And yes, those things matter. But trust in an AI transformation breaks at a very specific moment, when someone finds out the AI changed who gets credit for a decision, or who gets promoted, or, most critically, who becomes redundant. Communication doesn't fix that. Structural clarity does. You have to be explicit, in writing, about what changes and who owns what after the transformation, not just clear about the vision.
the we'll communicate our way through it approach works until the first wave of job redesignations, and then it doesn't.
Precisely. Thai organizations in particular tend to have high context communication cultures where difficult structural changes are often softened into ambiguity rather than stated plainly. That is exactly the wrong approach for AI transformation, where ambiguity about roles creates fear, and fear creates resistance that no amount of town hall sincerity can overcome.
Strong point. The second piece, agentic AI and global business services.
This one I think is actually more important than the trust piece, and I'm not sure it's getting enough attention in the ASEAN context. McKinsey correctly identifies that agentic AI, systems that don't just answer questions but take sequences of actions autonomously, is fundamentally an operating model question. You can't just bolt it onto your existing workflow. You have to redesign the workflow around what an agent can and can't do reliably.
Right. And the ASEAN exposure here is real. We have significant shared services and BPO infrastructure across the region, Thailand, Philippines, Malaysia, India at the BPO end. A lot of that work is exactly the kind of structured, process-following work that agentic AI is designed to absorb.
McKinsey's piece underplays this. They focus on the opportunity framing, how global business services firms can use agentic AI to create value. But for workers and organizations in ASEAN who are currently providing those services, the urgent question is transition risk. How fast does this actually move? Who are the early casualties? And what do you do with the talent that's currently doing that work?
They always underplay that bit.
In fairness, that's partly the client they're writing for. But it's why this briefing exists, to read the same material and tell you what the report didn't say out loud. The organizations that come out ahead from agentic AI and shared services are those who start the workflow redesign now, rather than waiting for the technology to be production ready and then scrambling. By the time it's unambiguously ready, your competitors will already have 12 months of workflow learning that you don't.
All right, takeaways to close.
3 things. First, fix the measurement framework before you add another AI pilot. The survey finding, 78% stalled, 0 at enterprise scale, is a symptom of a governance failure, and that failure is entirely fixable. Define your proxy metrics, name an owner, and start retiring the pilots that aren't performing. That alone separates the organizations that will scale from those that will still be presenting demos in 2028.
Second, model the new Thai data center tariff into your expansion economics before Q4. This is not a rumor, it's approved policy. If your capital expenditure assumptions are based on legacy electricity pricing, your business case is wrong. Fix it now, not when you're in front of the investment committee.
And third, on the Fed and FX, the 3.4% print is encouraging but not conclusive. Hold your hedges, watch the next 2 prints, and don't let one good number drive a treasury repositioning you'll regret if energy prices bounce back.
Sound advice, all of it. Thanks everyone for joining us this week on MultiPrime Briefings. I'm Ruth, alongside Matthew, and we'll see you next week.
Take care, everyone.